Let's talk about the second part of our show, which is understanding the strategy of averaging. Averaging down is a strategy where you buy more shares of a stock after its price has dropped. Now, hoping to reduce the average cost per share. The idea is that when the stock eventually rebounds, your overall profit will be higher because your average purchase price is lower. But just like trying to catch a falling knife, sometimes it works and other time it doesn't, leading to financial losses. So let's understand the rules of the game over here. I have with me Chandan Taparia, derivatives and technical analyst Motilal Oswal. Hi Chandan, good evening. And a very interesting task at hand for you today. Let's talk about averaging, and this is the strategy which a lot of investors now might want to opt for, if at all, they are a medium term or a slightly longer term investor. How would you like to explain this kind of strategy first?
Yeah, so thank you so much, Kavita, and really it's an interesting topic to talk about the averaging, and especially in this market scenario, which is continuously falling from last 5 months. First of all, I want to share that averaging works well when the major trend of the market is positive. But we have noticed that in last 5 months, month on month basis, the index is going down, and we have corrected by 16% from the top, and many mid cap, small cap counter has corrected by more than 20 to 40%. So it is very important when to do the averaging, when not to do. In 2020 to 2024, most of the averaging was beneficial because market was in a different bull run where index itself gone 2.5 to 3 times. But we need to keep in mind that managing risk is an important part, and taking the over leveraging is also the riskier when market trend is not in our favor. So it's good to do the averaging, but again, it's not advised to do the averaging when trade is losing. We can do the averaging in one or two tranches, but multiple averaging at the multiple decline is always riskier because trend of the stock is going down. So my key advice is that you cannot do the averaging for each and every counter. You can do the averaging for the selective heavyweights counter or the quality name, which looks good, but due to the market volatility or scenario, the stock again falls down from your buying price, and you opt to buy with the view that your average buying price will decrease. So this is the concept which you can apply. And I believe SIP is one of the interesting fact about the averaging, where we buy every time. Like every month we do the SIP. Price moves up, we are happy because the previous buying will give us benefit. But again, if you are buying lower, we are happy because the next buying will be at lower level. So averaging is a fantastic concept, and everyone needs to keep in mind about the major trend setup and the immediate outlook before doing the averaging on the selective heavyweights or the mid cap, small cap counter.
So now I want to understand the current falling market scenario. How do you know the right time and the right price to average on?
So it is very tough to do the timing of the market, especially when we are looking for very short term period. If you look at the bigger time frame to shorter time frame, the timing will be different and difficult always, and it requires more skill set. So in the recent market, let's say someone has bought a portfolio 5 months back or 6 months back when index was at 26,000, and right now we are at 20 to 500. So now what to do? First, an important advice: don't do the averaging where stock is continuously falling down. Try to do the averaging in the Hayward's counter, which has margin of safety with the view of recovery if broader market recovers. So at this current juncture, avoid averaging the mid cap, small cap, penny counter. Only do the averaging in the counter which has solid fundamental and corrected because of the overall FS sell flow or because of the overall market sentiment.
Be done twice or thrice, or it is just a one shot strategy that you should be applying on your investment?
See, it depends person to person because
Sure.
trading or investing in equity depends on the risk appetite. You cannot give the thumb rule that yes, this is the only rule you can apply. It depends. So,
One more question.
if let's say there is retail clients, I'm just taking one example that I have 5 lakh rupees and I want to invest in two blue chip counter. Let's say one from financial, second from consumption. So now what I can do is not as advisable to buy all the shares at one go because immediate short-term trend is negative, and I might find those stocks at comparatively lower level as well. If I wait for lower level and price doesn't come, there will be regret. So what I can do, I can buy 50% amount right now and I can wait for further decline. If that happens, I'll buy at lower price. If it doesn't, then I'm okay to buy at higher price. But at least I want to get an entry first, and then I'll decide whether should I do the averaging at lower price or should I do the averaging at higher price.
Sure. One
Okay.
last,
Again,
yeah,
now if
sure.
someone has bought the small cap and mid cap, then my advice is don't do until we don't see the change in the major market setup.
Right. One last question, Chandan, over here. What is a strict no? Like one strict no that you should totally avoid in the current market situation if you are trying an averaging strategy?
So my advice is don't do the averaging if you have traded in future and options.
Okay.
That is the clear advice. Because in FNO, if you are doing the averaging, that means you are adding your losing trade and probability of losing is increasing because already you got stuck and now you are adding quantity and you might trap more. So again, do the averaging in the counter which are comparatively holding even after the market decline, quoting near to your buying price, or even after the market decline, trading higher than the previous buy. So this is what one need to keep in mind in this market scenario. And I believe 80 to 90% stocks are lower than their peak. So you'll get very less counter. One can also use the moving average system for averaging, can follow the trend line, look at the top to down approach to understand which are the sector where we can do the buy on decline strategy. And one can apply a 2-time averaging or 4-time averaging. But beyond that, I don't suggest, and strictly no averaging for future and options, because option is not an investment instrument for investment. Option is all about buying in momentum, selling in momentum. But I have noticed that so many traders, they buy option at 100 rupees, they buy at 80, they also buy at 60. My advice is keep on buying. Max to max can go to zero. So that doesn't work. Option is all about momentum. So I never advise to do the averaging in future and option segment.
All right. So that's an important guideline if you want to average or have this strategy in your investments. Thank you so much, Chandan, for being on the show today and helping our viewers with this. All right.